Welcome back to the Trading Block. It's Kerry with another weekly breakdown. This time we're going over cash flow statements. Now, cash flow statements were one of the three reports that came in our earnings report or our quarterly reports that we went over last time. Now, a lot of market analysts and investors say that cash flow statement is the biggest of the three. That is income statement and balance sheets as well. But cash flow statements is the best and most important one, and I tend to agree after doing the research. Now, there's three sections of cash flow statement that we got to pay attention to. First, again, is operations or CFO. Now, what the operations part pays attention to is the net income, the business activities and operations of buying and selling goods and services or inventory and supplies, as well as keeping track of payroll and salaries for their employees. Now, what it doesn't keep track of is any income come from investments, debts, or dividends, buys, or share backs. Now, what it does do, it keeps a track of accounts receivable. Accounts receivable is not cash. So what it does is it subtracts or deducts accounts receivable from the net income to help balance out. Next up is investing. That's CFI. So what that does is it keeps track of the gains and losses from either the stock market or their investments from plants or other companies or mergers. So it kind of sees there like where the money's being broken up. Now, it also tracks the money that comes from property, plants, and equipment. Because again, those are investments if you're developing your company. This is also where we find capital expenditure. Capital expenditure is a big thing to pay attention to because if your capital expenditures are up or high, that may mean that cash flow may be low. But it's not always a bad thing. Because the beautiful thing is if your capital expenditure is really high, there's a chance that what that means is your company is growing and developing, so it's putting a lot of money into developing and investing and getting better, getting and bigger and doing bigger things with more companies, so it's broadening its horizon. So that's not always a negative thing if we see that. Now lastly is CFS, cash flow finance. Now what that pays attention to is the cash flow between the company's owners and its creditors, whether it be from debt or equity. It also keeps track of share buybacks and dividends paid out, as well as loans that's paid out or loans that were taken back. So again, it's keeping that out-in relationship of seeing where the money's coming in and out from. Now, if the company's finance money is too low or that part of the report is low, usually mean the company's paying off debts, put a lot of money in dividend paybacks, or they had stock buybacks. Thanks for tuning to the Trading Block. My name is Kerry. It's been nice breaking this down for you. Tune in next time when I go over income statement as well as balance sheets in the next two videos. If you like our videos, like and subscribe and share to your friends and comment down below. As well as check out our videos on YouTube at Trading Block, as well as our pages on Instagram and Twitter at The Trading Block Co. Thanks for tuning in to us.